Welcome to Real Estate Accredited, where we go over the nuts and bolts of investing in real estate. I'm your co-host, Jeff Rodriguez, with my co-host, Philip Schuligan. We are founders of Boost Capital Group, where we help professionals invest in um, real estate in general. And what we do here is we essentially go live, we record some training sessions, some informative sessions, and we post them on YouTube. We welcome folks to stop by and hang out with us, ask questions in real time, but know that these presentations will be posted on YouTube. And do please stay on our today's topic.
All right, thank you, Jeff. And our third co-host partner, Chris, couldn't join this evening. But today we're going to talk about evaluating multifamily investment opportunities, and actually more particularly the way we evaluate at Boost Capital Group these opportunities. So as usual, we are focused on on in-place commercial multifamily value add and syndication. And we have helped people invest in passively in 4,000 units at Boost Capital Group, and we've achieved a return of 2x equity multiple to date on full cycle deals. All right, so evaluating multifamily investment opportunities. So first, we're going to go over our deal filters, and I have a few slides. We're going to go over a few examples actually to uh, um, make sure that that a particular deal is meeting these requirements. And then towards the end, we are going to talk about a few, sorry about that, a few uniques that we use at Boost Capital
Should
Group.
have killed that dude. Make sure he's dead. Fucking around with that damn chick.
Sorry about that. I guess somebody was unmuted. So first, as I said, the deal filters and then the deal due diligence, what we take care of at Boost Capital Group. So our number one criteria for a deal to qualify for us is we're going to look for experienced sponsors, and particularly 5 years or plus in the business, at least 1,000 units or $100 million under management in the particular market, a minimum of four full cycle deals, preferably vertically integrated, meaning that they own a property management company, and also an additional criteria that the team size is in line with the number of properties managed. As mentioned earlier, we're going to go over an example and check that particular deal meets those criteria. So we're going to focus more on the team. And I on purpose, I made this particular presentation anonymous because we don't want to focus on a particular deal that we are assessing. But in this particular example, this group is, and by the way, this deal is a deal located in north of Fort Worth in Texas. And right now, this group has 2,000 units under management. So it's one of the criteria. They also started in business since 2018. So that's more than 5 years. And they have 50 plus employees in that particular market. So that's another checkbox. And actually that includes the property management company as well. And I think in terms of full cycle, they have done 11 full cycle deals. So that was, I think, the last 1,000 units, 5 years, vertically, and team size. We covered everything there. Next, we are going to look at the deal that is in a strong location, in a strong market. So MSA above 500,000, that is showing growth, diverse employers in diverse industries, also employment growth, and crime in the submarket that is low. So
Now, in regards to employment growth, keep in mind that the current trajectory of jobs being created in a certain MSA, maybe job growth has slowed down drastically as major companies lay people off because of the cost of capital, the cost of borrowing capital. So there's that consideration. However, if people are still moving to those MSAs, even if employment is based on statistics, employment is not growing, you have to consider what the caveat is. What is the correlation with the employment as well as population growth? So maybe there's more people moving into an MSA means more competition, meaning the company has more people to choose from. So usually we looked at the MSA's employment growth as a really hard line to examine. However, with like I said, the cost of capital and companies shutting down programs and projects, that has some effect. So you may have a market that you're invested in or interested in that there is a lower employment growth than before, but just dive deeper in and think about why that is. So that's just not something that you just cross off and say, oh, this is not a good market. So just something to consider.
Okay, so let's look again, part of our filter. We have population in the MSA, which stands for Metropolitan Statistical Area. So Dallas-Fort Worth and Arlington, Texas, it's a 7 million plus. Actually, as of the last number, almost 8 million people. So obviously way above the 500,000. Population growing, we have the average over 5 years is 1.65%. So it's a very healthy growth for a market that size. Diverse employers in diverse industries. So here I have from the deck, I have some statistics. And you can see that they are different. There's not one sector that is above, head and shoulders above every other sectors. It's very balanced. Trade, transportation, utilities being the first, professional, business services, education, health services, government is very well spread out, leisure, hospitality, financial services, not to worry there. What else do we have? The MSA employment growth. I think indeed, I think city data is a good source. And I don't have that particular. What I wanted to jump to is the crime in the submarket. So actually, the property is located, like I said, north of Fort Worth, in this little pocket here, and we like using crime grade to gauge anything in red is an area with high crime. So we are north of Fort Worth in this little pocket here. And you can see that it's a green area, really. So we're in good shape. I see Abdelatif had a question. No, so the answer for crime, we don't use, I use crimegrade.org. It's
Yeah, I
very
think you
visual.
already.
It's easy to use. I don't like too much city data for crime. It's a little harder to use.
Got you. Thank you.
You're welcome. So that was that. Okay, crime. Asset and business plans, 100 plus units. Why we want to do 100 plus units? It's because the larger the property, the easier and the lower will be the cost to manage the property, the lower the cost will be in general for renovations and etc. And we do multifamily in general, right? So like you have less risk, easier to manage when you spread out across multiple units, etc. And actually, I would even say we prefer 200 unit plus because now you're looking at institutional grade properties that are going to be owned and purchased down the road, possibly by, could be REITs or huge funds like BlackRock, for instance. Why we want to do class A and B? No, we prefer more recent properties. And I would say probably like or A minus, B is our preferred. C become which are older properties with more blue collar renters. They're a little more expensive, a little bit more expensive to manage and to operate. In general, third bullet point, we like the core plus or value add business plans. So we don't want core being a brand new property that you would purchase and there's no value add. So we stay away from that. We must have some value add. What core plus means is not a very strong value add. I would say usually you would do more value add on class C that you could bring to a class B level of finishing, for instance. And core plus, now you're bringing a B to A minus, for instance. And finally, we're looking for 3 to 5 year hold because we're just having a call with an investor earlier. It's very important to have a predefined time frame. You're going to execute your business plan over, say, 12, 24 months, sometimes a little longer. But then it's time the asset will be ready to be sold. And that's at the sale, at the disposition, that you're going to be able to capture a lot of the profits. So again, I take my example. It's a 288 units. So we are above the 100 plus. AB, I think there's a paragraph somewhere. Oh, let's see. There you go. It's a B plus class property in an A plus location, which is that's the best place to be. And you can see a little bit the pictures. Really great condition property. That's not and from 86. It was very well maintained, and it's, as we could see in the crime area earlier, it's in a pretty good area. So business plan, indeed, we're doing value add. We'll be able to increase rents, I believe, $200 plus. And the business plan in that particular case, I think, is 5 years. Right. So next, target returns. I'll prepare my slide here. So we're looking at 2x equity multiple in 5 years. Ideally, 8 to 10% cash on cash. With the higher interest rates, it's been very challenging, and between 14 and 20% IRR, which means internal rate of return. So those are the parameters on this particular deal. So we have the 2x equity multiple. Cash on cash, like I said, it's a little bit lower at 6% because of the interest rates currently, but internal rate of return, we're at 16%. So far, so good. This deal passed our filters. But what's next for us? So when we've reached these high-level filters, these pages that we've discussed, now begins really like the real work, right? And we call that the Boost Deal Differentiator. Actually, I think I should say this the Boost Capital Group Differentiator. Sorry about that. And we do have a more detailed 200-point due diligence checklist and grading sheet. I had it open earlier. Let's see. Give me 1 second. I can just show it to you real quick. There you go. And we cover investment details. There are 20 questions. Deal and legal, 10 questions, 32 for authentication. Debt structure, 22 points, property analysis, market analysis, etc., etc. And took care of the debt structure in this particular case. And so we go through different questions, and for each questions, we are assessing answers. We have very particular. So for instance, let's say there's a interest rate buy down cost. So here in this case, in high interest rate environment, which is right now we are in such an environment, buying down the rate may be a good strategy, but there's additional cost. So what is the percent of the cost to the loan, and what percent it takes away from the total annual cash flow. Technically, on this loan, there's no buy down, but there was a rate cap purchased. It was at a cost of 1% of the loan, I think. It was a spread of 2.25%. So in that case, I graded the rating at 5 and I got 15 points. But just to give you an idea, in this particular due diligence, we've reached a 92%. There are always a few things that are not perfect, but just to give you an example of all the steps that we take, as I said, we have 200 plus points here. I'm not going to go over this list. Maybe again, just the headlines, but we're looking at the offering memorandum, pro forma, the comps for rent comps and other sales comps. We look at the purchase and sale agreement, the loan documents, the organization chart, basics about the sponsors, as well as background checks, the track record, and a review of the portfolio. So that's our differentiator number 1. And number 2, or another set of differentiators, and we're using here active investor experience to evaluate risks. So I have a few of the things that we are looking at. We want to buy below market rates. We want that the current rates are below market as well. We want a low loan to value that is obtained as a debt on the asset. We want also a limited preferred equity on a deal, low year one growth compared to in-place numbers for stable assets. We want ample reserves. We want also, if it's a variable interest rate, we want a rate cap. And we want to see stress test and also multiple exit strategies. I think I closed my chat window, so I don't know if there are any questions.
There aren't any questions at the moment. Just some dialogue. Yeah, but if anybody has questions, please drop them in the chat or anything that they don't really get from this list. We'd be happy to provide a little granularity on it.
Yeah, no, I went pretty quickly over everything. Don't hesitate to ask any questions you may have. Actually, I think we just wanted to share our secret sauce here, secret recipe for evaluating multifamily investment opportunities. And the example that I used is actually one of our deals that we have offered through our fund. And it's just to give you an example about that. We take these steps, these filters, and then the detailed steps very seriously. That's how we add value to our investors. And so far in our fund, we've been pretty successful. I think we have a good recipe there for offering the best deal possible to our investors.
Like I said, if you have any questions, feel free to email us. There's our email addresses, QR provides more information, or you want to check out our website if you haven't. And there's the YouTube channel that I dropped the link a little bit earlier. Missed it. It's further at the top. Oh wait, no, that's not it. But yeah, it's a little bit at the top. If like I said, if you have any questions, comments, or just want to reach out to us, shoot us an email.
Yes, there's a question from Kiran. Do you look at specific regions? I think a big focus that we look at, and I forgot to mention when I use this data, this is data from the census website actually that I gathered. So I pulled data from 2010, but I'm more focusing on the 5-year. And I have all the MSAs. And depending on the size of the MSA, there's different thresholds that are needed to be met to qualify as a strong population growth. But basically, in terms of market, we're going to focus on any of these MSAs that have 500,000 or plus, and in addition, meet the criteria for the size in terms of average percent increase per year of population. And you mentioned Canada. No, we're not looking in Canada.
in greater focus in the Sun Belt.
That's at the end of the day. I'd be curious actually to plot these markets, but I actually let me go back. This map, albeit no, it was interesting. It's like rural and national population change estimate, though it's 2022, so it's not extremely old. But you can see interesting regions that grew quite a bit. So Texas, obviously, Florida, northern Georgia, where I'm located, Tennessee, throughout, Carolinas. But you have this is Maine, right? The very top here. The whole corridor here, like north to south, it's what Arizona, Nevada. I'm not super strong in American geography, so yeah, you'll have to forgive me. But yeah, those are the areas that had increased. But then it's like, again, they're looking at a rural and national. I think a lot of these areas here, they don't have like large cities necessarily. Jeff mentioned Sunbelt, Florida. And yet again, it's not every state, not everything is as strong. Are you able to get agency debt with this deal? No, we're not getting agency debt on that particular deal. We're getting a bridge type of debt, so variable rate. The idea behind that is to be able to exit the deal without prepayment penalty. Many deals have no return so far, are tough to achieve target returns in 5 years. Yeah, currently it's a difficult market. It's a difficult market, Abdelatif. I think there's still a high expectations from sellers in terms of prices. And really at the end of the day, or at least what is conveyed by the brokers. And because the cost of the debt is high, it's much, much harder to make deals work indeed. And for doing some mentoring on multifamily and looking at deals ourselves, I know that it's tough to make deals work these days. So but I think in hopefully starting middle of the year, the rates will start getting down. So it will become easier to buy deals probably, but I fear that the market will become crazy again. So prices will get high very quickly. But I think at the end of the day, they probably, I did a study in one of our prior calls, and you're going probably to look at 200 deals to make one to close on one, and probably like submit 10 LOIs. Yeah, it's a lot of work. Anything else that you may have? Otherwise, we'll wrap this up.
That's our time. So yeah, if you could just go back to the last slide.
Yep.
And if you have a chance, if you have any other questions, maybe that you think of later on, feel free to reach out to us and we'd be happy to help you out.
Absolutely. Yeah, you can subscribe.
Okay, you're on now.
Paula, raise your hand.
Yes, I put it in the chat. 10 LOIs in what time frame, please?
I don't. If you can underwrite 100 deals per day, that could be.
I know, but
It'd be
I'm
in 2
asking about,
days.
you said you submitted 10 LOIs within what time frame was that, Philippe? You
No, I'm
underwrite
just.
much
It was
faster than me.
it was hypothetical.
Oh,
It was not. It was
that's
not.
different.
It was not real.
That's different.
When I started, I submitted one LOI. I made one offer, submitted one LOI, and closed on one deal. That's it. It's like the odds of success were a little bit different. Now there's more work involved. Much more work.
Well, thanks, guys.
Yeah,
Y'all did a great job.
Thank you for
Thank
showing
you.
up. All right, thanks everyone.
Thank you for joining. Thank you, everyone,
you.
and have a good evening.
Have a wonderful weekend.
Thank you for the thumbs up, Kiran. I appreciate it.
Thank
All
you.
right.
Bye-bye.
Adios.